All right. Good afternoon, everyone, and welcome to the 17th edition of the A&O Insider series. This series creates room for direct conversations with leaders whose work is shaping business, markets, and institutions. Our theme today is the architecture of scale, managing risk and speed in high-growth startups. The theme captures a central tension in fintech. Growth rewards speed, but financial services also demands resilience, judgment, regulatory discipline, and trust from your consumers. Our guest has experienced that tension in real time while building a digital wealth platform and contributing to the development of Nigeria's investment profession. Before we begin the conversation, let me briefly introduce our guest, Mr. Razak Ahmed, CFA. Mr. Razak Ahmed is a Nigerian financial leader, entrepreneur, and institution builder whose work sits at the intersection of finance, technology, education, and capital markets development. He is the co-founder and chief executive officer of 𝘚𝘠𝘢𝘈, the president of the CFA Society Nigeria. He is an entrepreneur in residence and a course coordinator at the Faith Foundation, where he contributes to shaping the next generation of business leaders. As the CEO of 𝘚𝘠𝘈, he has played a defining role in expanding access to structured savings and investment products for everyday Nigerians. Under his leadership, 𝘚𝘠𝘈 has grown into one of Nigeria's leading wealth technology platforms, enabling over 2 million customers to build disciplined financial habits through technology-enabled investing. The company is a Y Combinator alumnus and has attracted backing from leading global and local institutions, reflecting its credibility, regulatory strength, and long-term vision. At its core, 𝘚𝘠𝘈 reflects Mr. Ahmed's belief that finance should be inclusive, trusted, and designed to serve society, not just markets. Academically, Mr. Ahmed graduated with a first-class honors in economics from Obafemi Awolowo University and holds the Chartered Financial Analyst designation. He is also a certified energy risk professional. His leadership record began early, including leading Nigeria to a top 4 global finish at the Students in Free Enterprise World Cup in New York, and receiving multiple international awards for service, innovation, and academic excellence. Beyond entrepreneurship, Mr. Ahmed is deeply invested in professional development and capital markets integrity. As the president of the CFA Society Nigeria, he leads one of the country's most influential professional communities in investment management. His service to the society spans over a decade, including chairing the University Relations Committee from 2016 to 2021. During this period, he led Nigeria's first participation in the CFA Institute Research Challenge on the global stage. He expanded university engagement across more than 20 institutions and strengthened ethics-focused programs designed to shape character early in young professionals. His leadership reflects a consistent theme. Strong markets are built on competence, ethics, and long-term thinking. Across business, professional service, and education, Mr. Ahmed is driven by a simple conviction that disciplined finance, ethical leadership, and well-designed institutions can unlock lasting value for individuals, markets, and the nation. His work continues to focus on building systems that endure, empowering people to compete globally, and strengthening Nigeria's financial ecosystem for the long term. Mr. Ahmed, thank you for joining us. We are pleased to have you here at A&O, and we would like to begin with the path that brought you here. So, we just went through your background and we see that it combines economics, professional investment training, and institution building. 𝘚𝘠𝘈 definitely required a shift. Building 𝘚𝘠𝘈 required that shift from not just analyzing financial systems, but to also designing one for the mass retail audience. Could you give us an insight into that professional journey so far? What inspired that transition from just investment and capital markets into building 𝘚𝘠𝘈? What gaps did you see in Nigeria's financial system at the time?
Yeah, thank you, Aaron. Thanks for having me here. It's a pleasure to be here today. I think to a very large extent, I still operate within the capital markets. I have not transitioned yet. Even though I have an energy risk professional certification, I doubt I will ever use that going forward. So I'm still within the capital market. I think what has changed practically in my career is working as a 9 to 5 to being an entrepreneur, right? That is the only transition that has happened. I'm still fully well grounded within the capital markets. And the founding of Cowrywise has a strong root in my experience working in Nigerian capital markets as an analyst. I started out my career with Meristem Securities Limited as an investment analyst, and then later on move on to Vertiva Capital Management as investment analyst as well. So I've worked in 2 different investment management companies in the country. And I think the foundation of Cowrywise can be traced to that experience. Even though at that time, there wasn't any direct correlation between the formation of Cowrywise in the future and my work experience while I was there, but the seed was sown. And the reason why the seed was sown was while I was in Meristem, I remember vividly the minimum investments required for a retail investor was relatively high. And even as staff, we were only able to invest in Nigerian stock markets because we were staff, so we had special privilege as staff. But for non-staff, you must have a minimum amount. And the picture was so clear that if I wasn't a Meristem staff at that point, there was no way I could invest in the Nigerian capital markets. And I think that experience was the primary driver of how do we make every single man in the streets have access to investment opportunities? How do we make the man in the streets have access to one of the greatest engines of wealth creations everywhere in the world, which is capital markets? The financial market is a prosperity engine. And that thought is what necessitated the foundation of Cowrywise. So when Cowrywise was founded, we knew we wanted to do investment management. But what we wanted to do differently was how to make it generate mass appeal so that we're able to serve the mass markets. And the only way to do that was to leverage technology. And technology enables us to serve the market in a very cost-efficient way and to be able to scale remarkably without necessarily inheriting the existing structural constraints that traditional asset managers have. And so, looking at the history, Cowrywise was founded based on our experience, myself and my co-founder. So for context, I'm a finance professional, core and core. My co-founder is a technologist, core and core. So the way I put it, I think it's a perfect marriage made in heaven, finance and technology, to establish Cowrywise as a fintech company.
Yeah, that's awesome. That's good to hear. I think that marriage between finance and technology has definitely benefited the retail markets at large. And like you said, Cowrywise was founded in 2017 and joined Y Combinator's summer 2018 batch. The business has since moved from just savings, but now brokerage services, digital sub-brokers, and serving more than 2 million customers. That makes scale kind of like a moving target rather than just a fixed milestone. You say, I want to build a platform for savings, but then you didn't just stop there. You kept moving, you kept developing, kept evolving to meet what the retail markets needed. So what did scale mean to you when Cowrywise was being built? And is the definition the same today? What would you also say has been the hardest part in scaling fintech?
I think there are different dimensions to the definition of what scale means, right? The first, at the initial stages, can people even use the products?
Yeah.
When a company is founded, I think scaling is, can people use it? Can you find the first 10 people, the first 100 people to use the product? Because when the idea was conceived, it was primarily in the heads of you and the co-founder, or probably the staff as well. So how do you get external people? And that cycle continues to enlarge. External people being your immediate family first, friends second, and people that you really don't know use the product. So that concentric cycle continues to expand over time. So initial concept of scale will be, can you get people you don't know to use the product, right? That was the initial idea of scale. And at that point, you're not thinking of dominating the world or solving world hunger or having a national relevance. You're just at the initial level of survival mode. how do you ensure the idea survives the market? How do you ensure the idea survives the brutality that exists in the market? Will people say this is a stupid idea? Will people think, or will your friend think that, let me just use this product because you are my friend? And even when that hurdle is crossed, then for non-friends, people who don't know you, strangers, they don't owe you anything. So the concept of scale at that point is, will a stranger who doesn't know you from anywhere, who probably reads about the product, the solution you're providing, can they be convinced to use the product? When you continuously have increasing number of non-friends use the product, that is the initial idea of scale, the initial definition of scale. But over time, scale definition changes. It changes to, how do you get the first 100,000, the first 200,000 in terms of user acquisition? It changes to, how do you increase the number of people who believe in the solution you're providing to work for you, to ensure that the products get developed to a scale that can attain national relevance. So you have to scale people as you scale the product, as you scale user acquisition. You also have to scale regulatory engagements. Because I remember vividly when we started in 2017, SEC didn't even know we existed at that point. Yeah, lucky for us, we didn't care that SEC didn't know we existed, because we're still trying to figure out what was working. We had a separate regulatory arrangement at that point. It was primarily designed to be a partnership. So we didn't have the license to operate at that point, but we partnered with the licensed entity. So to us, we're outside the purview of Securities and Exchange Commission, but we're within their regulatory confine, but indirectly. But as we grew, we had to come under the fire of SEC. That you have to be regulated directly. SEC actually wrote us even after we met with them before COVID. COVID came, delayed the entire process, but with scale, that means with the adoption of the product by a lot of people, SEC then saw the need for us to be regulated. That is another definition of scale. When the regulator sees that you are important, you are growing at a scale where you are relatively not necessarily systemic within the capital market, but you're growing, your influence is growing dramatically, and so you have to be regulated. So the dimension of scale can start from the early adopters of the product. How do you even get friends and non-friends to use the product? The second is, how do you employ people to sacrifice their professional lives to work for you just because they believe in the vision you're advocating? That's another scale entirely, people. Because as you scale user acquisition, you need to also scale people that work with you. You need to employ people. You need to grow them. You need to develop them. They need to continuously see the matching concept between their own development and the growth of the company when it comes to user acquisition, right? So those things matter. And then national relevance. All the regulators will come to you because you are now occupying important position when it comes to important national discussions like taxes, for example. Government will come at you. So that's also another definition of scale, right? So scale evolves, definition of scale evolves, but at the back of all these dimensions of definition is you want something that is important, right? So that importance is now whether it is the importance that is defined within the confines of your office, within the confines of your state, or within the confines of your country, or within the confines of the world. So the magnitude is what changes from time to time. But the ambition to actually increase one magnitude at a point in time, one magnitude per time, is what makes the definition of scale different from the initial stage till now. So right now, have we scaled? Relative to where we're coming from, we've scaled. But we also have the different definition of how we want to scale in the next 5-10 years. Right. Sure. So it changes from time to time. It's just a continuous iteration of growth, metrics, and continuous ambition to keep reaching for the next frontier. And that is what scale is. So I really don't know where we'll scale to. Of course, there is that concept of you understanding what the market size is. But when you operate within a market segment, when the market size is also changing, so you are always moving towards a moving target, right? The target is moving, but you're moving towards it. So scale changes with time, but underlining all the changes is ability or the ambition to move one step closer to the top.
Thank you. Thank you very much for that. I would say personally, I remember using 𝘚𝘠𝘢𝘈, many years back, even before COVID, maybe 2 years before COVID. And it's definitely been a privilege to see how you guys have grown. I mean, now 𝘚𝘠𝘈 is an SEC licensed fund manager. And I believe you also have a related entity that is digital sub-broker. Your products are delivered through software, both web, the application as well. And, the obligations around delivering those products, they come from, the market infrastructure. They also come from financial regulation. So we see that 𝘚𝘠𝘈 definitely sits at an intersection of finance, tech, regulation, and these areas might evolve at different pieces. So for example, do you think regulation can sometimes lag behind technology? The regulation hasn't met up with the kind of technology or products that you want to push out. How do you navigate decision-making during those times or when those things conflict?
So the decision-making around regulatory engagements and navigating regulatory corridors, the decision-making processes are different at different scales of the company. I remember when we started, to a very large extent, we weren't giving so much consideration to what SEC would think because we're just starting. We're not that big. So the impact of what we could create at that point was minimal. So if we created a product at that point, we'll just launch it and we'll go to the market without giving any consideration to whether SEC approved it or not. Because we're not directly under the supervision of the SEC. We had a partnership arrangement with the regulated entity, in this case, Maristel. But as we grew, as we scale, we noticed that we needed to limit how fast we move because the consequences of getting it wrong are now much severe, right? Especially when it comes to regulation. So right now, if you have to design a product and we have to release the product to the customers, of course, customers will most likely adopt the product because we sampled their opinion before. But without the approval of the Securities and Exchange Commission, we can't release that product. So as we scaled, it became really, really slow for us to churn out products as we used to when we're smaller, right? And for regulator, usually regulators won't pay so much attention to you when you're still small, which is the whole idea of regulation, being slow. It is largely because of what they have to prioritize. They have to prioritize the deployment of their resources to more systemic players within the market. If you're just starting with one man, most likely they might not know you exist as a company, right? So, but in our case, from this time we started in 2017, 2018, we engaged SEC directly, went to the office in Abuja, engaged them. We dimensioned what we wanted to achieve in the markets, primarily retail, driven by technology, the service structure, the products, and our vision. And the SEC approved the fleet at that point. But there was no license category for us, given the nature of what we wanted to do. And that was what slowed the licensing regime until post-COVID, when SEC then wrote us that you guys have grown to this level. They just have to come in under this license structure, but with some level of understanding that you're using technology to drive user adoption, right? So that understanding is there. So regulator might be a bit slow, while innovators move further into the future. But the most important thing is for you to remain consistent in the market and continuously win the trust of customers. Regulators have to catch up with you, because if they don't, the trust you claim you have, the customers you claim you've acquired, might actually disappear overnight. All it takes is for the SEC to write a letter or to publish something in the press or in the press to say you are an unregulated entity.
Yeah.
And the kind of chaos that can cause and the kind of damage it causes to trust that you've built over the years can be irreversible. So to a very large extent, while innovators can be further ahead of regulators, it is also quite important that we are conscious of the need to wait for regulators to catch up with us. Because otherwise, what we spent years to build can actually be derailed overnight, especially if you do not have regulators that are understanding or that are very welcoming to new ideas. So in summary, at the early stage, you can move fast, break things, but as you grow, the speed diminishes because of the consequences of getting it wrong. And when I say getting it wrong, it is not necessarily limited to you getting it wrong as a company. It extends to you getting it wrong on behalf of the customers. Because in this type of business, where you have to manage people's wealth, you have to manage people's life savings. You want to be sure that you do things by the books. It's extremely important. People are you are their stewards. That stewardship is extremely important. So you don't want a situation where you cause panic for them to make decisions that they will regret for the rest of their lives. So you want to innovate fast, but as you grow really rapidly, you also want to ensure that you carry regulators along. It has its cost. Regulation has its cost. It slows you down in the short run. But I think you are better off having it in the long run. So it's about sacrifice, trade-off, trading off short-term pains for long-term benefits. So I would rather slow it down, get all the regulatory approval, and be existing for the next 20, 30 years than to rush everything and be dead in 2 years just because a circular was released that destroys customers' trust in the company. So early stage, you can move very fast, but as you grow, undoubtedly, you have to slow it down a bit.
Thank you very much. That definitely aligns with what 𝘚𝘠𝘢𝘈 is trying to do. I would say that obviously another part of building customers' trust is public disclosures. That regulated entities have to make. That's one example of trust. If I open, for example, 𝘚𝘠𝘢𝘈's in terms of use of their privacy policy, I'm going to see all the required disclosures many times to make me feel a bit more confident to use the products. So we definitely see that trust in a fintech is actually like a brand asset. It's not something you may be able to quantify in specific numbers, but customers are likely to use or stay using platforms that they trust. For example, a person of 70 years old might not be able to understand why I would put millions of naira into a product that came out 9 years ago. They might not just understand this, but 𝘚𝘠𝘈 has built that much trust, with a customer like me. So I wanted to ask, how do you build, trust through your internal systems? Is there some form of legal and compliance there? Is there some form of, technological standards? What are you doing internally to build systems or to deploy systems that build customers' trust?
Trust. So customers' trust is something that gets built over time. It is very difficult to have a watershed moment to say this is when the trust starts building. It's something that compounds as well from time to time. And one key thing that I can point to that is primarily responsible for the level of trust we've enjoyed over the years is excellence. Because we have this large young demography of customers who have tasted what world-class experience looks like from the various apps that they use. They use Facebook, they use Twitter, they use Instagram, they use Snapchat. These are world-class apps, even though they are social apps, but they have an expected behavior that or an expected experience that an app should have or that they should have using an app. So even though we're doing wealth management, we cannot design something less than that experience for them in terms of engagement, the sleekness of the app, the user experience of the app. So when they come into the Cowrywise ecosystem and they have similar experience to the apps that they've been using that are globally accepted, you are indirectly building trust because you are now in a good company. You are in a company of world-class app. You're in a company of world-class experience. So excellence in product delivery, in user experience is one less talked about source of trust building, especially for retail customers. You have people who are less than 30. Average age of our customer today is about 27, 28. They cut across the country. They don't even know where our office is. Even when they know, they can't leave Ibadan to come to Lagos, or they can't leave Kebbi State to come to Lagos. They have to trust that the company I'm dealing with or whoever is behind this company is trustworthy. And you don't have the opportunity to speak to them directly. You want to acquire millions of customers. You don't have the luxury to speak to each of them to convince them. You need to develop your touch points such that when they interface with your touch points exudes trust. I remember at the early stage when we launched, this was in 2018, there was someone on Twitter that commented about the quality of our website. It was so funny and disturbing at the same time because it shows the psychology of user behavior in Nigeria. The guy said, I really don't care if you guys are scammers. The beauty of your website alone is enough for me. If you scam me, you deserve to scam me. So when you listen to that, there is the initial leg in that people must have. When they interface with your touch points, they should see trust. They should observe trust, even before using the product. That is extremely important. So being in the company of global excellence is an important source of trust. Then the second part is patience. Staying long enough in the game until irrationality becomes rationality. Because if you don't have that staying power, the market might be irrational longer than you can stay in the market. For example, you just mentioned that you signed up on Cowrywise in 2018, and you started using the product in 2024. If we're not around in 2024, even though you signed up in 2018, you will not benefit from using the product, neither will the company count you as a customer. So there has to be that staying power to benefit from the compounding effect of trust building over time. So trust gets built over time, and excellence in product delivery, meeting customers' expectations are major factors when it comes to trust building, especially when it comes to financial technology products, like the kind of product that we offer. And then time resolves many things. And just to cite another example of this is, we look at the numbers of customers who get converted over time. Usually, people get converted within 30 days of signing up on Cowrywise. But we also see people who get converted 2 years, 3 years, 4 years after they sign up, right? What that simply means is that you will not win the trust of everybody from the get-go. But your activities, your actions in the markets, in places, within the regulatory corridors, among your employees, among your stakeholders, can trigger them to take action to continuously use the product or to start to use your products. So trust is created by decentralized effects of your actions in the markets. We've seen instances where people activated their Cowrywise account just because they read that we're doing some CSR projects. So there was a time we renovated a pitch within Lagos, within Ikeja, a pitch of a primary school within Ikeja, it was a CSR project. Some people activated their CarryWise account just because of that, just because they feel this company has a soul. So we are not selling savings to them. They were convinced to use CarryWise just because they believe the company has a soul, not because they believe we have the best investments to offer them. So there are so many factors that are responsible for building trust. Selling your product is one of them, but there are 1,001 other things that are responsible for trust building. So as a company, one needs to be careful in the kind of image you portray out there, because those things go really, really far. So for example, we are currently present in more than 400 tertiary institutions in the country. What that simply means in terms of trust building is that we have thousands of students across the country who are CarryWise ambassadors. Those students have parents. And that was something we did at the early stage of recruiting CarryWise campus ambassadors. We wrote to their parents to let them know their kids are now CarryWise ambassadors. In a way, we're not telling the parent to open a CarryWise account. We're not telling the parent to save or invest with us. We're only telling the parent that we're a responsible company. And every customer, potential customer, wants to live and dine with a responsible company. Then the next question is, what does this company even do? They'll have the kids. And the kids are our ambassadors. What do you think will happen? We acquire the parents as customers, even without telling the parent to open a CarryWise account. So trust building is a process, and it has to be done without necessarily selling the products directly. It can be done by selling the product indirectly, by being a very good company, honestly. Just be a very good company. Be a company with a soul, and the trust you're looking for will get built over time.
Thank you. Thank you very much. I think it's seriously different, the kind of trust that CarryWise is able to build in young people these days. I think you also didn't mention that CarryWise, those students actually do get a scholarship. They get some, yes, they get some scholarship as well. I think I have a friend.
So that was a recent one.
Was a member of that. Yeah.
Fantastic.
So I remember myself getting into a serious argument with someone, I think last year, and I was telling them that you should actually, this product has saved their license. The person just couldn't understand, how I trusted this product so soon. You've only been using it consistently since 2024 or something. How can you be? Yeah, but that's just what trust does. You were there over a long period of time. Your product offerings are just very, very diverse. So you have the personal savings, you have the mutual funds, money market mutual funds, equity mutual funds, you have stocks directly, Nigerian stocks, you have the business, treasury with Sprouts and other things, investment as a service and other things. So this just suggests that, digital wealth management can become sort of like an ecosystem, not necessarily just an app, because like I mentioned, you also have the web browsers and other things. So it's clear that you've helped to digitize access to savings and investment products. Do you see any further advancements, or do you see any more complex products being introduced into the markets, maybe that would give CarryWise or other financial wealth management providers an edge? For example, at least personally as a nerd, I think AI has some role to play in some of these things in the future. And I think CarryWise already incorporates some AI summaries in the stocks to help people understand, the order books and different things better. So what examples do you see that could give wealth management apps a competitive edge?
Wow. So what we've done with scaling at CarryWise is to scale based on the need of our customers, right? When we started out with primarily savings, average age of our customer was much less than 29, 27 that it is today. It's in early 20s, right? And the product vision that we have has always been that we will scale our product offerings to match the life moments of our customers, right? So right now, in addition to all the major products we mentioned, we also have kits, Cowrywise kits, which takes care of the need for the kits of our customers, right? Basically, we're already cultivating the next generation of Cowrywise customers. Because as a parent, you also want to take care of the future, the future of your kids financially. So as our customers begin to get married, as they begin to have kids, we needed to build a product that serve that segment of the market. So as our customers graduate from schools, get their first job, they definitely need to start investing. So one key product, the other product that we're thinking about, like retirement, for example, of course, there is the pension plan that happens naturally by law, but we all know some of the limitations associated with that pension. Are there opportunities for private retirement plans, for example, that can leverage the opportunities that exist across different asset classes that can enable them retire well by the time they are in their 60s and 50s? Yeah, that will be coming on stream. Then across different asset classes as well. Today, if you look at all the products that we offer, we have fixed income products, we have equities, we have global securities, right? These are different asset classes that can be combined in different ways to meet different investment objectives for different people, right? If you are relatively old, for example, you do more fixed income. If you are relatively younger, you do more of equities, take more risk because you have the capacity to take more risk. So we will be introducing more asset classes so we can have enough tools that can be combined to generate better return experience for our customers in the long run. However, in doing all of this, one key thing that we think will happen in the next few years, right? In the next few months, actually, is improving user experience when it comes to their understanding of how to invest. So just take, for example, you are a young investor. All you know is you know yourself. You don't know anything about investments, but you want to benefit from investing. You should be able to do that with AI, for example. AI knowing you fully, you should be able to have an engine, a proprietary engine that can handle the investments in an autopilot way. We are currently connected to bank accounts. Why do you have to make decisions to invest when you can actually have a system that automatically does the investment for you? We still have the underlying assets. We still have the underlying asset of fixed income, equities. Those are given. Those won't change. Anywhere in the world, they are the same. What is different is the how. How do you invest in equities? How do you invest in fixed income? How do you connect your bank accounts to that investment account? What portion of your income gets invested? Is it 20%? Is it 30%? Is it 40%? How do you manage that experience over the next 10 years to ensure that you get the best return from your investments? I think investment managers who are able to help customers, especially retail customers, to do this seamlessly will definitely have an edge into the future. And yeah, I'm not announcing anything here, but we definitely want to have that edge. Yeah.
Disclaimer, everyone. Thank you so much for that. As like I mentioned, as a big nerd, I'll be looking forward to any of those things. So as we mentioned when we're reading your bio, you sit at two very useful vantage points. As CEO of Cowrywise, you are a market participant. As president of the CFA Society in Nigeria, you are involved with standards, ethics, and the development of the investment profession at large. What sort of regulation do you think would be helpful to scale or improve the Nigerian financial markets today and make investments maybe a bit easier for Nigerians?
Okay. I think one thing we haven't done really well, but we are getting it right now, that we didn't do well before as a country or as an industry, capital market industry, is to allow retail investors to have the best experience when it comes to investing. Best experience defined as retail investors believing that the market has their back.
Yeah.
Retail investors believing that the HNIs or the corporates will not take them for a ride. Retail investors going through the process of investing without any hitches. I think we've not done that well. We didn't do that well in the past. But we're seeing changes now. And the kind of regulation I will want for the capital markets is a regulation that focuses heavily on streamlining retail investor experience in terms of their participation in the markets. And this touches structural, infrastructural platforms that currently exist that supports the entire operations of the capital market. So if you look at the way capital markets work, there are so many parties. So take Carrywise, for example. If you're investing in stocks, that stock will have a registrar. If you're investing in a mutual fund, the mutual fund will have a registrar, will have a custodian, will have a trustee, will have a fund manager, will have auditors. So there are many parties involved behind the scene that are part of this. So what we've seen is that some stakeholders have advanced when it comes to technology adoption than other stakeholders.
Yeah.
And those other stakeholders are then, holding everybody down. For example, I think we still have significant miles to cover when it comes to the kind of experience customers have when they claim their dividends, especially with the registrars, for example.
Yeah.
Right. The experience is not smooth. It can be a lot better. We experience this every single day. So the kind of regulation I will expect from the regulators is regulations that focus on building the best experience for the retail investor, because it's an asset that we have. We need to have millions of retail investors in the markets. And you can only have millions of retail investors in the market when those retail investors trust the market's systems, that the systems are built to support them. Yeah, SEC is doing well in protecting retail investors, but there has to be regulations around infrastructure that can scale at the same rate at which innovation is scaling. I shouldn't want to claim my dividend now and then I have to, fill paper form, 3 forms, 4 forms. Today, it still happens. Today, that shouldn't be. If I'm in Sokoto, how do I trust that system? The system should be seamless. However, the good news is that some systems have already been built that can be leveraged to make this happen. And we've seen that for the new retail customers that have been onboarded, the entire experience is seamless. Because, for example, if you are a new retail investor in Nigerian stock markets, the account opening process is now can be instant. Right now with CSCS API, it can be instant, which is fantastic. And your dividend payment can also be seamless because the account, the bank account you're using is where your dividend get paid into. Right. But there are other instances where you've already invested, your bank account is different from the bank account with the registrar of GTB, registrar of Stanbic, that needs to be streamlined because those things matter. Overall, the market needs millions of retail investors, and regulations that supports the participation of retail investors should be prioritized because they are the future. When it comes to capital mobilization, one key thing that can differentiate the market from a market that is toothless is market with high number of participants. And if there is something we have as a country today, is we have the head count. Yeah. We might not have the income, but we make up in head count what we don't have in income. So instead of having 1,000 people with 1 million, we can have 1 million people with 1,000. And if you have a technology that enables you to aggregate all of them together, you can create the same impact that 1,000 people with 1 million will create. And that is what capital mobilization can make happen. And by the time you have large number of people participating in the market, it brings about a lot of efficiencies. It becomes really, really difficult to manipulate the market because you have large number of buyers and sellers in the market. Price discovery becomes relatively easier. Efficiency is fostered. So long-term, the benefits are just huge. But to realize those benefits, millions of customers need to participate in the markets. Today, we have BVN of about 70 million in Nigeria, which means we have unique customers, unique BVN holders of about 70 million.
Yeah.
Why are they not all participating in the Nigerian capital markets? We might argue about low income. Yeah, it's a factor, but it is not the only factor. We still have barriers limiting people from participating. And I think that is the area the regulation should focus on.
Yeah. I think I agree. The issue of unclaimed dividends is actually, it's major. I think some of us have parents who invested in stocks, 10 years ago, 15 years ago, and they have like dividends that have compounded or that have been just there.
Yeah.
And definitely there needs to be something that makes it easier. Maybe they could just fill a form simply, or a technology, an app or something that kind of helps them to claim those dividends just much easier. To our participants, if you have any questions for our guests, please feel free to drop them in the chat box now. I will attempt to read them very soon. So just as we wind down, as we mentioned earlier, 𝘚𝘠𝘢 is a Y Combinator alumnus and has attracted institutional backing, but it definitely has operated in a sector where customer protection, regulatory confidence are central to basically your long-term value. Those constituencies, customer protection, regulatory confidence, they are not always operating at the same timetable. So for investors, investors typically want fast growth. These are people who've invested in 𝘚𝘠𝘢, your institutional backers. But then running a regulatory or a regulated financial business, it demands caution, at times it demands discipline. How do you balance that?
So it's a tough one. But the most important thing is to have stakeholders or backers, institutional backers, whose objectives align with your objective. So wealth management is a slow burn. It's not something that can miraculously just grow like payments. It takes time to build confidence because you're holding on to people's money. You are not a conduit for money flow. Yeah. You are a destination, right? So, and before people can accumulate a lot of money for you to manage for them, it requires long-term trust building process. So it's a game of compounding before you start seeing results. For example, what we do in 1 week today, in terms of growth in AUM, it took us 4 to 5 years to do that in the past. So basically, what I'm saying, what we did in the first 5 years of 𝘚𝘠𝘢, we're doing in 1 week today. We are not smarter than we were. We're not working 48 hours today compared to the number of hours we were working before. It's just a game of patience, a game of process, right? So if you have investors whose objectives are aligned with yours, especially when it comes to impact, retail, technology, finance, you are more likely to have it easier because they will understand what it takes to do that. Yeah. But when the objectives are different, then that is when the issue is. And there is one thing that is very important when it comes to scaling as well, is that the most difficult thing to do, especially in this type of business, is ability to scale profitably. You can scale, but it may not be profitable. And lack of profitability reduces your optionality generally. But if you are able to scale profitably, your optionality spectrum widens materially. And it is the kind of growth, the kind of scale that is resilient enough for any funding environment, whether there is winter or summer, you can still sustain your business. And so there is that sense of responsibility that you need to be into because you're managing people's money. Failure should be a rare occurrence. If you're building a social media app, yeah, you can wing it and fail. Nobody cares because, yeah, I can't use the social app, I move on. But if you're managing people's money, it takes a different level of care and responsibility. Because when you fail, lives are on the line. Right. So you have to do things with extreme care, understanding, and maturity to be able to stay in the game. So for the backers who have that strong understanding, it makes it a lot easier to get along. But when the understanding and goals are different, and you have people who probably just want to invest because they believe being an angel investor can make you rich overnight, then you begin to make short-term decisions that will cost you long-term. But when you have institutional investors who understand what it takes to build scale profitably in this type of business, then you are in good hands, you're in good company. And I think we're very lucky to have those kind of people. If you look at our cap table today, most of our investors have long-term horizon, and they are perfectly aligned with the kind of objectives and goals and vision that we have. Impact plus outcome. Impact plus profitable outcome. They are perfectly aligned with those things.
Thank you. Definitely having the same vision is very, very important. So my last maybe serious question for you before I move on to the audience questions is, through your work with CFA Society and Faith Foundation, you've had, you spent time developing and advising younger professionals, younger entrepreneurs, and that will give you sort of a unique angle into understanding the kind of mistakes that, founders may repeat before the consequences become a bit more obvious. So if you're advising a fintech founder today, what is one risk maybe they are likely to underestimate in maybe the first 3 years, 3 to 5 years-ish?
So a fintech founder, right?
Yes.
Not just a founder.
Fintech
founder. I think they shouldn't underestimate the risk inherent in their lack of experience. Because fintech is a specialized field. So there is the finance part, then there is the technology part. Technology is, you can have different technology everywhere, applied in different industries. Yeah. But finance is a specialized field. If you have to do wealth management, for example, you should understand what wealth management is. You need experience to know what equities are, what fixed incomes are, what global securities are. You can't just take your way around that. So there is a need for experience there. The same thing if you're doing neobank. Banking is a specialized field. It requires experience. You must know how to underwrite credits, how to assess risk. Those things you can't just get with technology. Technology can enable you to do those things easily, but there has to be the experience there. So if you are looking at being a fintech founder today, irrespective of the field you're looking at, whether insurance, whether asset management, whether payments, whether banking, or other verticals of fintech, don't underestimate the inherent risk in your lack of experience in that specialized field. If possible, acquire the experience in those fields before you start your fintech company. I think that's one key thing, because I've seen companies make decisions that, in hindsight, you don't even need hindsight actually to know that you shouldn't be making those kind of decisions because you're operating within a fintech industry or you're operating within an asset management industry, right? For example, an asset management industry is a thin margin business. The only thing that gives you real revenue and profitability is scale, especially if you're operating at the retail level. Yeah. But if you have incorporated some expense structure that also scales with the business, you will never become profitable. And expense structures such as referral fees, For example, if you're managing mutual funds, you have 1.5% fee annually, but you're giving people 2%. How on earth will you ever be profitable? The implication of that is that you scale, but you're scaling your problem as well. And that is one easy way to die. When your problem is scaled and you think you are building a big company, you will die easily. The main idea behind scale is that you should scale the positives while the positives then dwarf the negatives. So scale what brings in revenue while your cost reduces over time. But we've seen instances where companies scale everything. They scale their problems, scale the opportunities. And, it's easy to operate a company when your revenue is, say, 10 million and your cost is 5 million. You're making a 5 million naira loss, right? But just picture it when your revenue is 100 billion and your cost is, when your cost is 100 billion and revenue is 50 billion. You're making 50 billion. 50 billion, you're still making the same 15% loss, but in absolute term, it's a different discussion entirely. It's a different discussion entirely. So at scale, you need to have figured out your unit economics to ensure that as you scale, you are not scaling your problems. You're actually scaling the solution and value. So experience can help you bridge that gap. So if you're a fintech founder looking at setting up a fintech today, I'm not discouraging you. All I'm saying is, if you don't have the experience, don't underestimate the risk you're carrying. Focus on bridging that risk. It could be you bringing in experienced people to help out. But if you have the option, I think acquire the experience in that specialized field before you set up that company. It is extremely, extremely important.
Thank you. Thank you very much. So I'll just move over to some of the audience questions and comments. So a question from Glory. What advice would you give founders and young professionals who want to build sustainable businesses rather than just fast growing ones?
Yeah, I think my last statement speaks to this partly. The most important thing is to understand what drives the business, what drives value for you and what destroys value for you. It's as simple as that. Beyond, you don't have to be an accountant at the initial stage. You don't have to be a finance professional at the initial stage. Just common sense. What is it that drives value for me? What is it that destroys value for me? Then focus your energy on those things that drive value and ensure that you minimize the value destroyers, right? Then over time, you then bring structures. Accountant will then come, and prepare your revenue for you, prepare your costs for you, and then you have your income statement and balance sheet. But you don't need those guys from day one because they'll only be motivated to work for you anyways when you have something going. Most people will only be motivated for you. You can't just wake up today and say you want to hire a CFA charter holder, except if you're bringing the person in at a very high level, you have the experience to do that, or a chartered accountant, Those things take time. But overall, have a good understanding of the business you're building. What drives value, what destroys value, and scale the drivers of value, and try and neutralize the destroyer of values, basically.
Yeah, thank you very much. The next question from Buki is, how do you keep up with investment news, and what would you recommend for persons looking to become financially literate?
Oh, this one is very simple. Just subscribe to 𝘚𝘠𝘬 newsletter. I'm sure it will do 100% of the job.
Yeah,
it's free.
I mean,
you don't have it's free. It's free.
Yeah.
And we've done a fantastic job such that I think over the next 1-2 years, you continuously receive personalized content that can enable you up your financial literacy game.
Yeah. I mean, I can personally attest to that. I think even when I wasn't consistently using 𝘚𝘠𝘬, I was subscribed to the newsletter. So I used to receive some of these emails that will tell me, this is how much you save, this is how much you invest. So even though I wasn't doing those things at the time, I kind of knew that, okay, when I'm making, or when I start working, because I wasn't actually working a lot of the times I wasn't using it. But I knew when I start working, I have to save, 50, I have to do this one, I have to 30, 20, things like that.
Yeah.
So you definitely get a lot from from using 𝘚𝘠𝘢𝘕's newsletter. I think, yeah, I mean, AI is also there these days. I think you can try to get ChatGPT to send you daily summaries of financial news and things like that. So
yeah,
that's always an option. Ayomide has a question. You spoke about how scale can also evolve to national and regulatory relevance. Given that fintechs in Nigeria often have to answer to more than one financial regulator at once, how do you and your team navigate engagement with multiple regulators?
Okay, I think this is not something peculiar to fintechs alone. Most companies have to answer to multiple regulators, of course, with varying degree of responsibilities. For example, in 𝘚𝘠𝘢, our primary regulator is Securities and Exchange Commission. But we also have fintechs that have both Central Bank of Nigeria, Securities and Exchange Commission, and some even insurance. That's NICOM, right? Insurance
NICOM.
regulators as regulators. We also have, the tax regulators. We have competition regulator.
Yeah.
We have, they're just data privacy and so on and so forth. So there are so many regulators that you have to deal with. It's not something peculiar to fintech. It's something it's something generic to, every company. If you want to run a successful company, you have to figure out a way to manage all these layered regulators. But of course, at the core, you have your major regulator that you have to be responsible to. In the case of 𝘚𝘠𝘢, it's the Securities and Exchange Commission. But we have to deal with other regulators anyways. It's a fact of life. You can't, I don't think there's a silver bullet to that. You just need to do things by the books. It's as simple as that. They'll give you some hard knocks sometimes, but to sustainably withstand their gbas books, just do things by the books. I think you'll be fine long term.
Yeah, I agree with that comment. Yeah, so our last audience comment isn't actually a question, it's a comment. And he says, it's from Julius. He said, I use the Sprout product for my agro business fund management. I was happy when I got the email inviting me for this session. And I'm happy I joined because I learned one important thing. There is no rush to scale. There's a season for every stage to build a sustainable business and uphold customers' trust and acquire the required knowledge and scale the positives. Thank you, Sprout and Mr. Ahmed.
Yeah, fantastic.
Yeah, so
thank you for the comments.
Yeah, thank you, Julius. Moving on to the hot seat questions. These are very unserious questions. If the very first one is, if you could have any superpower for just one day, what would you choose and how would you use it?
Superpower?
Yeah, any. 24 hours.
Yeah, for us to have 24 hours power.
For just that 24 hours?
No. For us to sustainably have 24 hours power.
24 hours power. Okay, fair.
Yeah. I think there are so many things that can be derived from, there's so many positive externalities that can happen from stable power supply. And so many burdens that can be taken off our shoulders just because you don't have to think about diesel, you don't have to think about generating set. At corporate level, at individual level, productivity can skyrocket. Well, it is a precondition, it's a precondition for productivity growth. It doesn't mean if you have power, you'll be productive. You can decide not to. But it has to exist before we can start talking about productivity growth at individual and national level. So yeah, I will just, the magic wand. There shall be lights and there'll be lights.
Yeah, like someone said, before God created anything, first created lights, then he went ahead to
see, that's the more reason why we need it.
Yeah. So your profile describes you as someone who, you sort of contribute to teaching and developing other people's professional development and entrepreneurship. And obviously advice is a very important way leaders handle work. What would you say is the best piece of non-work advice that you've ever received? Non-work
advice.
Yeah.
Well, it's related to work, but it's not work. Is that you just have to enjoy the journey. Just enjoy the journey, because for every accomplishment, either in life, in business, professional life, personal life, for every accomplishment, once you achieve it, it becomes, the utility drops drastically. And then you're looking up to the next thing, right? So you shouldn't have any accomplishment as a destination. It should just be a dot in the journey, and create time to enjoy every single moment. When you're meeting your friends, enjoy it to the fullest. Don't hold back. When you're at work, enjoy it to the fullest. And this boils down to creating the environment that allows you to enjoy those moments. You shouldn't hold back from having fun with your friends, just because you think there'll be time in the future. There is no time in the future. This is the future we've all been talking about. Yeah. So we just have to enjoy it, either in professional life or personal life. Just enjoy it. Figure out a way to enjoy everything.
Thank you. Thank you very much for that. I mean, something I'm going to take maybe a bit more seriously. And my last and final question for you is, I know you're a Real Madrid fan.
Yeah, a la Madrid.
Yeah, a la Madrid. I'm a Manchester United fan foremost, so we're sort of like cousins.
So, no, we're not. We're not. We're not. We're not. We're different.
We have too many relatives. Go on.
No, we are not on the same. We are not on the same pedestal. No.
Nah. Fair enough. I'll give you.
Yeah, you should know your place.
Yeah, I'll give you. So what is one football fantasy that you would like to see become a reality? Is this signing Haaland or what?
I actually want us to sign Lamine Yamal, to sign him, but send him to Crystal Palace. Yeah.
Oh my God.
Yeah, that would be my plan. I want us to sign him and then send him to Crystal Palace.
Interesting one. Yeah. That's a very interesting one. Thank you very much, Mr. Ahmed, for a thoughtful and very, very candid conversation. Today's discussion has showed us that scale is not simply a matter of adding users, launching products. It requires choices about where to slow down, how to build controls, how to be patient, preserve trust as the institution becomes a bit more complex. On behalf of 𝘚𝘓𝘕, we thank you for your time. We thank you for sharing with us, and to everybody who joined, thank you for your time. Thank you for your participation, for the audience questions. And this brings today's program to a close. Have a wonderful afternoon and rest of the day.
Thank you for having me. It's been a pleasure. Yeah.
All right.